Welcome to Closing Day. My name is Jeff Delgrand and I am your host. Closing Day is a show all about real estate. We cover everything here on the show, everything from how to buy real estate with no money down, how to use government money to buy real estate. Now that's a good one. We cover about selling real estate, staging, appraising. Now we're going to cover a really interesting topic today, which is financing. So our goal today is we're going to be informational, educational, inspirational, and hopefully somewhat entertaining, and give you some good tips that'll help save you time, money, and make your whole real estate experience more enjoyable. So the financing topics we're going to cover today are all about financing real estate. And to help me cover that, I've got with us is Laura Morgan from the Mortgage Center in Orangeville, and Dan Johanis, also with the Mortgage Center in Toronto. Welcome, guys. Thanks for coming on the show.
Thanks for having us.
Thanks, Jeff.
Yeah, so let's get this started. First question is, why would somebody use a mortgage agent?
You want to handle this one?
Dan?
Sure, I'll jump in.
Okay.
So I guess I can speak from a personal point of view. So I've both used mortgage specialists in branch and then working with a mortgage professional in the broker channel.
Mm-hmm.
And I think working in the broker channel, it's advantageous because you have a lot more products, and they work with you to kind of find the best product to suit whatever situation you're in, right?
All right, so a product being like a financing, type of financing?
Exactly, yeah.
Okay.
What type of mortgage fits your situation?
Okay,
Yeah.
All right. What do you think, Laura?
Well, I think it's important to note that we're licensed as agents and brokers, so we have to go through a training program in order to give the advice that we give. I would also say it's a more personal experience. You're not a number with us. It's a hands-on, one-on-one experience that we walk you through from start to finish. So.
Yeah. That sounds really good. Now, what about fees? I mean, is there a cost to using a mortgage agent?
For the most part, we're paid directly by the lender. Mm-hmm. If your mortgage falls within an institutional or bank lender. There could be fees as far as a potential, maybe an appraisal or legal fees, but that's with any mortgage you do, whether it's through a broker or someone else. If you're working on the B side or on a private side, there may be fees associated with your mortgage, but again, it's case by case.
Okay.
Yeah, and just to add to Laura's point, that's one of the first things that comes up in a conversation with a lot of my clients is, how do you get paid? Like, what's the process here? And usually it's always a good point to have that conversation right in the beginning and let them know that, because they're working with a mortgage professional that's licensed, we're paid primarily by the banks. And like Laura said, in some of the situations where we have to go outside of the typical scope of financing, there may be a fee on top of that, but all of this is communicated up front, so there's no surprises on closing day.
That's a good point.
So for a normal person purchasing a home, the bank covers your fee, they pay you.
That's correct, yes.
So there's no charge per
And
se.
we only get paid on closing too, so at the end of the day, if you don't feel comfortable in the process, I mean, we're there to help you on probably one of the most stressful purchases you'll ever make, right? So we want to make sure that you're comfortable in the product, and on closing day it goes smoothly, and then we get paid after that.
Mm-hmm. Okay, and when do you think a person should seek out a mortgage professional?
Anytime you're looking for financing to do with a home. I mean, we can do a lot. We can do lines of credit. We can do first, second mortgages. I would say always chat to a mortgage broker first or agent first.
Yeah,
I would agree with that too. I don't think you can't have a mortgage professional on your side too early, and regardless of what you're doing. So if you're refinancing, if you're looking to put money down on your first property, maybe it's your 10th property, whatever it is, us as mortgage professionals, we're kind of helping you create that strategy or that plan.
Mm-hmm. Right.
So you have a good game plan before you go into the market, because the market's been a little crazy the last year or so, and if you can kind of come up with an overall game plan, incorporating your real estate professional, your mortgage professional right from day one, it's never a bad thing.
Right. Yeah. So it's funny when I talk to real estate agents, for example, and this is what I think the mentality is. People buy emotionally, and they back it up with logic. So we would think that if I'm going to buy a house, I better make sure I got my money first. But you know what I'm going to do is I'm going to call a real estate agent first, because that's the emotional side.
Right.
And it's usually the real estate agent that hits the brakes. Well, wait a minute, Jeff, do you know if you can afford a house or not? And that's when I'm like, oh yeah, I better call someone about financing.
Yeah.
Yeah. So
No, it's very true.
yeah, it's funny how that works, but it's just human nature. So,
Of course, yeah.
yeah. So the real estate agents point that out to me all the time, how they get the calls first when you think it does make more logical sense to call the finance person to see what you can afford. But
Right.
okay, so let's talk about the process. Like, someone calls you, and so Laura, let's start with you. Someone calls you and says, I'm interested in buying a house. What steps do you go through with that person? Where does it start?
So, I mean, you're going to sit down and kind of take the details in that you want to find out what product suits them best. Because we're brokers or agents, we have a whole suite of products that would fit them. So I would say we take the application, we kind of filter which lender would work best with our clients, submit their application, get an approval, and then we let the clients know they can either start shopping, or if it's a refinance, they can,
Okay, so they can get that done sort of before they go to look for a house and
Definitely.
find out what size castle they can
Yeah,
buy and
yeah, definitely.
how. Okay, so that's like a pre-approval, right?
Yeah.
Okay, some of the terminology.
Yeah.
So they get a pre-approval. They can go out and they can take the pre-approval to an agent. So what happens then? They start to shop, house shop.
Yep.
And what would happen after that?
They'd find a house of their dreams. They'd let us know. We'd speak to the lender about the particular house, make sure everything fits, and then we get them an approval, which means we get a commitment from the lenders stating, here's what we need from the client in order to make this deal work and get them their money, and kind of filters through from there.
Okay. Now, I'm guessing it's going to be similar in Toronto, Dan. Is it? Is there? I just know the houses in Toronto are what, $1 bazillion compared to.
Yeah, pretty much. And then you've got like 10 square feet to live in for $1 bazillion. And it's crazy because sometimes people will actually remove a financing condition on it. We've seen that where there's been quite a few bidding wars taking place, and the issue that comes in is that if you've paid way over the market value or even the appraised value, you've got to come up with that additional money, right? So. It's always a good idea to kind of get us in the beginning, kind of formulate that game plan, and then take it from there. And like Laura said, it's, you submit the documents to us. We're essentially underwriting the deal before the underwriter gets it. And I always tell my clients too, it's a good idea that if you're house shopping, let me know before you put that offer in. Send me the MLS listing so I can put that in your file. I can crunch the numbers and then see. Is if they're dealing, so in Toronto, a lot of the buyers are dealing with condos, and condos come with condominium fees. So if those condo fees are too high, and I just actually found this out today because I had a client that put an offer in, and the condo fees were too high that it threw their ratios out, right? So luckily they have a financing condition, they can go back and start shopping again, so.
Right, so the condo fees are part of the cost,
Right.
almost like a mortgage payment, right? Being
You
part of
got
the
it.
cost.
Yeah.
I read the other day that a good sort of ballpark way to look at it is for every $500 a month, that's about $100,000 in financing. So if you're buying a condo that has a $500 a month condo fee, that's almost $100,000 worth of financing it's taking away from you, or financing capability,
Yeah.
right? Does that
The same.
sound right?
That's 100%, and so you definitely have to factor that in. And then if we look at other liabilities like auto loans, you think that $500 or $1,000 payment on I don't know what you're driving, a Tesla or something. It's that's eating away at your affordability too when it comes time to shop for a house.
Yeah.
Right, so I shouldn't be buying that Lamborghini yet?
Let's hold off.
I would wait.
Hold off, Jeff.
Oh, darn,
Yeah.
well, the weather is starting to turn, so I could sit tight till spring.
Yeah, I can get you a good bicycle though if you'd like.
A good bicycle?
Good bicycle. Yeah, you don't need one in Toronto. Or you don't need a Lambo in Toronto.
Oh, okay, all right.
Get around
well,
on a bicycle.
in Orangeville, I think we need something to
Yeah.
get around.
Yeah.
But that's good advice. So don't overspend on big ticket items, I guess, before you buy. And
Exactly.
For sure.
Yeah.
okay, now someone wants to buy a house, and it's, what's the saying? They can't find the perfect house, but they can find a house and make it perfect.
Right.
Right, I've heard that saying before. Real estate agents use it, where you can actually finance some of the like if you find a house you need to do some work on, how does that work? You know, if you want to buy it and do some renovations.
Well, you can go for like a purchase plus improvement.
Right.
There's a whole suite of products that are tailored towards people that are looking to buy a fixer-upper.
Okay.
Right. So we can explore those products as well.
Yeah.
Yeah.
So somebody can buy a place, finance the renovations.
Exactly, and then those funds would be sort of released in a series to help with the renovations. It's like a draw.
Okay, well, that's good to know,
Yeah.
right? Because I think that's a powerful
Definitely, yeah.
tool to have in your tool belt when you're buying a house.
Yeah, because sometimes, like in this market too, because it's been pretty crazy, especially in the springtime. You know, getting out of one house and then saying, "I want to get into a bigger house." Well, maybe you can't afford that, right? You can't necessarily afford to jump around across the street or into a new place. So let's look at maybe expanding the footprint you're in right now. Do a little bit of renovation, open up those rooms, and you know, you can stay put.
That's interesting. What if someone's going to sell a house and they need to do some renovations? Can they come to a mortgage agent to get financing for that?
For sure. We offer, I mean, if they have an existing mortgage and they need some additional funds, we have a whole suite of products. We can either attach a second mortgage onto the home, give them the extra funds they need. We have something called a refi plus improvements, so we can take a look at the loan that they're currently in.
Oh.
We can potentially see how much extra we can get based on the equity they have in the home, and set them up so they can sell and get top dollar for their home.
What if they don't want to sell? They just want to renovate their house. Can they take advantage of that too?
Of course, they can do that as well. Yep.
Oh my
They don't have to
gosh.
sell to do that.
I hope my wife's not watching this. I'm in trouble now.
Yeah. I mean, that's the beauty of working with an agent or someone on this side of things, is that we have a whole suite of products that we can work with. And we definitely, I mean, that's our job as mortgage agents. It's to put you into a product that works best for what you're looking to do. So we package up the deal and get it done the best for you.
So customizing.
Yeah.
And then what about accessibility? You know, I can only call my lawyer up to 5 o'clock at night. Does the same work with the mortgage agent, or how does it work?
Dan works 24/7.
Pretty much, yeah. Sorry, I got to take a call. No. I think it really depends, because we're all independently sort of, you know, running our own sort of businesses. So it really depends. I've seen some mortgage brokers that are completely, or mortgage agents that are 9 to 5, Monday to Friday. I like to be a little bit more accessible, and my background coming from entrepreneurship, I didn't know what a day off was, so I was always on. It was always go. So putting that hat on and then jumping into the mortgage industry, I try to keep myself accessible.
All right, I'm just going to interrupt for a minute. We're going to
Sure.
go do a break. When we come back, we're going to talk about interest rates, whether they're going up, they're going down. We're going to get your opinion on
The
that.
magic ball.
Yeah.
Sounds good.
Thanks for tuning in. We'll be right back. Welcome back to Closing Day. I'm Jeff Delgrand, your host, and with me today I have Laura Morgan from the Mortgage Center in Orangeville and Dan Johanis from the Mortgage Center in Toronto. And today we're talking about financing real estate, because we're all about real estate. And we were talking about the different stages of financing, whether someone would see a mortgage broker first or a real estate agent first. We all know who you should see first, although we all see the opposite person first, right? Now, we talked a little bit about the steps. Someone calls, they come in and see you, you get their application. Now, once they've got a live deal, or say whatever, a deal that
It's in play.
there we go, and they contact you, what goes on with the deal from there? What happens to all that paperwork?
Okay, I guess You want? I'll take this one.
Go ahead.
So, I mean, once I've had that conversation with a client, we figured out the affordability, they've put an offer on a property, it's been accepted.
Right.
The first thing I ask for is the purchase agreement and a copy of the MLS listing. So generally, I collect all the other documents up front. It's just a few things: pay stub, letter of employment, a T4, and then we kind of get to work on packaging that deal. We shop around, we look at the different lenders, the different products, and at this point, we kind of have an idea of, as a buyer, what you're looking for, your long-term plan, if this is like the end game, or if this is like a starter home, or whatever it is.
Right.
So then we take that into account, and then we package up the deal and we submit it to the lender. Sometimes it involves making a phone call first, just to see, if this is a good fit, and then from there the ball's rolling. And if they have a financing condition on it,
That's when it gets fun.
That's when it gets fun.
Yeah.
Yeah, that's when you're under you're under fire.
A time constraint to get it done in a certain period of time.
You got it.
All right, so Laura, once the deal gets to a lender, what do they do with it?
So the lender's going to underrate the file. So they're going to take a look at the file, and they're going to kind of scrub it and say, we'll give you this money, but we need to prove that you make the income that you tell us you're going to make. And we need to prove that you have the down payment and where your down payment's coming from. So they're going to send us back something called a commitment with a list of conditions in the commitment. So the conditions are, as Dan said, we're looking for a pay stub and a job letter, T4s maybe. We're looking for proof of your down payment, whether it's a gift or savings or you're getting it from somebody else, borrowing it for that matter. So they're going to send us that list, and we're going to go to our clients and make sure, as Dan said, we like to collect everything up front just to save any issues down the road. But if there are other things that they're looking for, we let the clients know. Hopefully they can get it back to us as soon as possible. Now, usually this day and age, most deals require an appraisal. So we'll get an appraiser involved at this point, order an appraisal on the home. And once all the conditions are satisfied, so once we've proven to the lender everything that we said in our initial application is actually true, the lender from that point says, okay, we're ready to fund the deal and give you the money.
Okay, now this appraisal we're talking about, is that like when your next door neighbor says, hey, that house has got to be worth $400,000, or is that when the real estate agent says, hey, this house has got to be worth X amount of dollars?
No, it's a certified appraiser will have to go out to your property. Now the appraiser has to be on the lender's approved appraiser list, which that's fun as well, because not all appraisers are on everyone's list. But the appraiser is a certified appraiser that goes out and does a full report, takes pictures, makes any comments on the home if there's any issues that they should mention, and then the report comes back, and what it does is it gives us an idea of the home, and most importantly, it gives us a value that we work with.
Okay.
Yeah.
So once someone gets into a home, and let's say they've owned it for a year, and they have a 5-year mortgage, because I think that's sort of probably the more popular mortgage. I know there's other options out there. And they want to, say, move out of the country, and they have to pay that mortgage back. There's a penalty, right?
Correct.
How do these penalties work?
Yeah, and it's depending on what product you have, it can cost you a little bit of money, or it can cost you a lot of money. So this is where it's always good to have that conversation up front to figure out, okay, like I said, is this a starter home? Or if we're dealing with maybe, say, an older couple that's established, the kids are off at school, and we're renewing or refinancing, a 5-year might be a better product for them. But triggering a penalty on it, that's where we kind of go in, and we'll have to calculate and see what that penalty would be. And I think I read a statistic where something like 65% of Canadians will break a 5-year mortgage within 36 months. So 3 years in. So it's a very real financial risk that I think you need to account for right up front.
Adding to that, I think it depends. I mean, you think everybody knows the general options when it comes to rates. So there's a variable and a fixed rate. So if you're in a variable mortgage, you're probably going to pay less of a penalty because they calculate it based on 3 months interest.
Right.
If you're in a fixed mortgage, they do something called an interest rate differential calculation. So essentially, the bank is trying to get back the money that they're going to lose if you break the mortgage early. and you don't fulfill the 5-year term. So there's different calculations they use. Some of our lenders, I mean, the great thing for us is that we know what the lenders charge and how they calculate these penalties.
Right.
If it is somebody, like Dan said, that is potentially going to break their mortgage, and either they know it or we see it, or there's any thought that there may be a break or a move, we try to put them with somebody called a monoline lender, which actually calculates the penalties on a lesser amount. Some of our other lenders, the penalties can be very, very high based on the calculations they use.
Mm-hmm.
So.
Right. So I've heard of some, astronomical penalties,
Yes.
30, 40, 50,000. But monoline lenders, you can avoid it with the monoline lender?
You don't avoid a penalty, but you avoid the astronomical penalties. The way they calculate it is, without getting into too much information, it's pretty much the money they're going to lose, and it's based on your discounted rate versus the posted rate at the time.
So the way they would lose money is if interest rates went down and you handed their money back, then they'd have to put it back out at a lower rate.
Yeah.
That's how they lose money.
Yeah.
Now, if interest rates go up and you give them their money back, do they give you part of that profit?
No.
Would be nice.
Would be nice, but no.
No? Just a one-way street?
No, just a one-way street.
I don't know why I don't find that hard to believe. But now, how much should a person borrow? They're coming to you for advice.
Mm-hmm.
I mean, how do you find that number?
You can take it, sure.
I mean, if I'm sitting down with a client and they're asking me a general question of how much can I borrow, without getting into the particulars, I generally say 4 times your income. That's just a quick, easy way. The lenders are going to look at it in that you can afford your debt, so your mortgage, your interest on your mortgage, your heating, your taxes, and all your debt that you're carrying can't be more than 44% of your income. So there is a calculation they use. There's ratios they use, and those are the top of the line. You can't qualify for any more than that generally.
All right, but a good ballpark is 4 times your income.
Yeah,
I like rules like that.
It's
easy
quick
rule.
and easy. Right.
Easy rule.
Yeah, that would make it easy.
Yeah.
All right, now we talked about this earlier on. Just before it drops out of my head again, interest rates, right? Interest rates go up, interest rates go down. Where do you see rates going in the future, short term and long term?
Crystal ball.
Crystal ball, right? Let's consult it. It's kind of a loaded question. It's a difficult question to answer.
I know.
And I think if we could all accurately predict where rates were going, well, for me, I'd be playing the lottery or doing something else. But what we do know is we can sort of hedge that risk. And like Laura had mentioned earlier, we have variable products, we have fixed products, and we can look at some of them are convertible too, right? So if we get into a variable, and historically variable rates have always outperformed a fixed product. Now, if it looks like the rates are going up and you're sort of risk adverse and you don't want to kind of wait it out, if we get you into the right product or with the right lender, and monolines are a great example, we can get you into a product that can be converted over with a quick phone call or a letter, right? Okay. So, but as far as where rates are going in 6 months or a year, it's hard to say. We've looked at sort of global uncertainty. I've looked at some of the economists that are predicting where rates are going. We've seen two successive rate increases by the Bank of Canada. Where it's going next, I don't know. You want to take a shot, Laura?
No, I mean, I can only hope that they're going to hold steady for the next little bit because of the rate hikes in the last little bit. I mean, it's hard to say. Rates are one of those.
Rates are something that most clients want to have that conversation on rate, and I think it's very important to understand too that even if we had a doubling of rates overnight, that doesn't equate to your mortgage going up by 100%, right? So it's not.
So if rates double, how much would my mortgage payments go up?
Well, if you're in a fixed rate, it's going to stay fixed until your term's finished.
course, that makes sense.
That's a good point.
But
Yeah.
once your term's finished, that's when the negotiation begins, right?
Yeah.
Yeah.
Okay, so well, let's take it another step further. Let's get out of the rate thing because you can be 50-50 on which way that's going to go.
Nobody knows.
Yeah.
What about real estate prices? Now, just curious, we'll direct this to Dan because
Sure.
you're downtown Toronto.
Yes.
What's the feel down there? Are prices going to continue to go up? Are they going to go down? Are they what is the
You
what's
know,
on the street?
I've got some relationships with real estate agents that definitely we've had this conversation
Yeah.
on more than one occasion. And I think if we had this conversation back in the springtime, it'd be a very different outlook than right now. And just from my own experience and seeing how, you know, a lot more of my clients are not getting into the bidding wars that we saw, you know, even this time last year. It's definitely looking like the market isn't as hot. I don't know what kind of correction we're looking at. So, you know, some people will say the sky's falling.
Yeah.
I don't know if it is.
Well, what do you think?
No, I don't. I don't think this. I don't think the sky's falling. We've definitely seen we've seen more inventory on the market.
Yeah.
So the bidding wars, as Dan said, they're just not there. Houses are staying on the market for a lot longer. They would go in a week before, and
Yeah.
now we see them, you know, 30, 60, 90 days on the market, and that's not unheard of in today's market. I don't think we're going to have a big correction, but we're definitely seeing a plateau.
Okay. Well, I'm going to have to wrap this up. I want to thank you, Dan, and thank you, Laura, very much for coming on the show.
Thank you.
I want to thank everyone out there for turning your sets on and viewing the show with us. And we'll see you next time on Closing Day.